What's up, guys? Today I wanted to share a few reasons why a lot of people lose money from yield farming concentrated pools. I've made these mistakes before, and I found that if I avoid these mistakes, it would make it much easier for me to turn a profit when I yield farm. If you guys are new here, my name is Richard. This channel is mainly about yield farming and investing. Hopefully, these videos would help you make more consistent profit or get started with yield farming. It's one of the most profitable things I've found in crypto. That also allows me to generate a lot of cash flow. If you guys look at my wallet here, I'm sitting at 5.28 Ethereum profit on this wallet and another 8.61 ETH profit on the other wallet. So roughly 13 to 14 ETH of profit, depending on how these altcoins perform. A lot of these are crypto to crypto pools, and I started my investment with Ethereum. That's why I like to measure profit and loss in Ethereum. And even if you guys change the reference value here to compare it against holding, I'm still up roughly $13,000 and averaging roughly 50% APR on my capital. So pretty solid here. Recently closed out this position for a nice 0.51 ETH of profit. You can see I started with only 3.08 Ethereum here. So let's dive right into the video. The first mistake that I see some people do is they basically capitulate, meaning that they sell out of their investment when the prices are really low, only to watch it climb back up again. So a perfect example of this is Ethereum. You can see that Ethereum basically went up to $4,000, not even to its previous cycle high, right? In the last December and January, and drew down more than 60% to under $1,500. So if you guys bought the top here, or if you're new to crypto, then that would have been a pretty painful hold, right? But you can see after a ton of people capitulate out of their positions, the prices actually recovered to roughly $24.58 right now. So if we measure from the top to the current price, we're down only about 40% compared to selling your investment down at the bottom and locking in that 60% loss. And if you guys are investing for the next 5 to 10 years, then you shouldn't worry about these price fluctuation anyway. What we want to try to figure out is if these assets would be trading at a higher price 5 to 10 years from now, and I think the demand for Ethereum will grow. That's why I'm more than comfortable holding Ethereum through these drawdowns. And when there are profit-taking opportunities like what we saw back in December and January, then we could lock in some of our gains as well so that we don't have to hold all the way back down and then wait for a recovery. But again, the main mistake is basically capitulating out of your position just because the prices are doing badly. And this is especially true if the whole market is pulling back. I don't want to sell out of my position into stablecoins because the fundamentals behind the token might be the same, right? It's only trading at a cheap price because people are selling it to take some risk off the table. And in fact, that's the best time to be buying, right? When everyone is fearful that the price is going to drop further, then that's typically the best time to buy. For example, I bought some Solana and Bitcoin. When Solana's price dropped all the way to roughly $120, that's when I entered. I took some profits when it bounced back to $180. And then you can see the price just basically fluctuates from like being oversold and then being overbought, right? And even now, a lot of altcoins are trading at a cheap price. For example, Bonk, I'm currently in this position, is still trading at a price that's quite a bit away from the all-time high, right? Roughly 70% down or something. But the main idea is I don't want to sell out of my position if I believe with reasonable chance that the price might recover above my entry. And if I want to get out of those positions, I typically like to basically wait until it's at least above my entry or at my entry before I exit the positions. And if you guys are feeling a lot of pain with your portfolio, there's a few things that could help you out. So the first thing I like to do is negative visualization. My portfolio currently is sitting at 135K, but it dropped all the way down to roughly 70 to 80K in the last pullback a few months back. So what I want to do in that scenario, if I want to practice negative visualization, is I want to imagine my portfolio getting cut in half. So from now, let's say I imagine my portfolio being cut to like 60K. because of a really hard pullback, then I would feel much less pain than comparing my portfolio all-time high to my current portfolio. And you can do this over and over again, right? Let's say my portfolio pulls back from 135K to 80K again, and then I could visualize, basically from 80K retracing all the way down to 40K. So that's one way to kind of like trick your brain into thinking that, everything is okay. And we don't want to just practice that, right? We want to take steps to actually retain the profits that we're making. But that's just one way to reduce the pain, to make sure that you're actually thinking clearly when you decide to sell rather than capitulating based on fear. And another exercise to basically control my fear that I like to do is I like to zoom out and not think about these short term things too much. I basically visualize myself being like a very small part of like this world, starting from me sitting in the room. Then I start zooming out from like, on top of my house in like a third person view, then to my country, and then through the world, and then through the whole universe. And then we basically realize that, our life is actually pretty small in the grand scheme of things. And the crypto prices actually don't matter that much, right? Especially if you guys are not putting, your life saving into crypto. And that's not what you should be doing anyway, especially if you guys are investing mainly in altcoins. And before we go any further, these are not financial advice. I'm just sharing what have helped me in the past. Be sure to do your own research before you decide to invest. And the last thing that actually prevents me from capitulating is making sure that I have a diversified portfolio, which leads me to the second point. A lot of people actually don't have enough diversification. That's why they see a ton of pain when the market drops. If we look at the other chart here, which are mainly altcoins, because it excludes the top 10 crypto, if we measure from the top to the current price, you can see we're still sitting at a roughly 50% loss right now. And if we measure the deepest drawdown, we saw a roughly 60% drawdown on most altcoins. And those numbers are even higher in specific tokens like meme coins, or even Ethereum. We saw a 65% drawdown from the top. So it's definitely not easy to hold through those periods if you guys are mainly into altcoins, right? Sure, if you're all in into like the one token, then you might be, doing well. For example, if you put all of your portfolio into Hyperliquid, especially when it's trading below $10, you could have seen your portfolio 3x, right? But a lot of times we're not going to like make these perfect trades. And I find that for most people, especially if you're not, doing crypto full time, you probably have a much better chance to succeed if you have a more diversified portfolio. Because if you went all in one token and you were right, you would make a ton of money. But if you were wrong, you would also lose a ton of money. We never know the future. So if you guys want to protect your portfolio, then you might want to spread out your bets, right? Hold some Bitcoin, hold some Ethereum, hold some Solana. And if you guys are yield farming altcoins like I am, you can see I'm actually in quite a few different positions, right? Pixel to ETH, Bonk to ETH, and a bunch of different other ones so that I have some allocation. You can see this AI XBT pool is not doing well at all, but it's being balanced out by these other pools, right? Like MOG and ETH and Bonk and ETH as well. So that's why I always diversify my asset. And I'm not just talking about crypto either. I'm talking about your entire portfolio. I have roughly 50 to 60K sitting in like traditional investments, mainly stocks ETFs like VOO, which is the S&P 500 ETF, or this HCHD dividend ETF, which are basically more value companies that have solid financials that are paying a good dividend and are growing their dividend over time. So those are all good investments that has a little bit of correlation with crypto, but has much less volatility. So it makes it much easier to basically hold through these periods of drawdowns. And if my crypto portfolio doesn't do well at all, I still have these investments that would grow to a good size over the next 10 to 30 years. And we could buy other assets like gold as well to basically balance out our portfolio, or real estate. As long as the gains are outpacing inflation, then it's worth it to do. If you guys hold a lot of bonds, for example, and the interest rates are too low, then it might not be worth it to buy those assets. So those are some things to consider as well. And the third mistake I see some people make, or I used to make is compounding all of my fees. If we go back to these others chart here, you can see that the way altcoins move is that it does like a huge run up. It stays up here for like a few weeks and then it draws back down again, right? If you guys are compounding your gains all the time, you're not actually locking in these profits, right? When you should be. For example, back in December, altcoins as a whole ran up to 400 something billion, and then it draws back down to below 200 billion. Now it's sitting at 233 billion. So instead of compounding your fees all the time, let's say altcoin does another run up to 400 billion or to 500 billion, we want to be locking in those profits, right? Either into stable coins or into Bitcoin, into gold, into other assets that might have a smaller drawdown or little to no drawdown at all, right? You could still earn yield on your stable coin and then buy back into these positions when they're oversold again. And we could see the similar pattern in the previous cycles too. We see a huge run up, stay up here for a little bit, and then we see a big drawdown. Huge run up, stay up here for a little bit, big drawdown, and then eventually the bear market hits. So we always want to be securing some portion of our profit. If we go even further back, it looks the same, right? And sometimes the window of taking profits could be only like 1 to 2 weeks, right? So you actually have to lock in those profits and not wait for the market to take it all back. What I personally do now is I take roughly 25 to 75% of my fees and sell it into stuff like Bitcoin, Ethereum, stocks, and even stable coins if I want to hold a little bit more stable coin in my portfolio to reduce the volatility and to basically prepare for a crash. And I found that over time, it has been better than just compounding all of my fees, especially if I'm yield farming more altcoin pairs. And the fourth mistake is not having a backup plan. Let's say I'm yield farming Ethereum to USDC. I want to know my exact numbers of what would happen if Ethereum's price, let's say, go to its previous all-time high near $5,000 or pushes past that. What's my plan going to be when that happens? Or if the price dumps out of my range, what would I do in that scenario? So it's always a good thing to have like a few options that's available before you actually hop into the position, right? So you kind of want to think through like the best and the worst case scenario so that you're prepared to act when these moves happen in the market. And if you don't have a plan in place, then a lot of times you're going to panic when these moves happen because you don't know what to do, right? So one strategy I want to share with you guys is this liquidity rotation strategy. You can use when the market is overheated or when your pools get pumped out of range or dumped out of range. So let's say I was starting with crypto to stable pools, right? Ethereum to USDC, like what I just said. And let's say Ethereum rips to, let's say, $8,000 and it puts me all into stable coins for that pool. What I could do instead of chasing the range upwards, I could use some stablecoin strategies to basically generate yield with stablecoin LPs like USDC or USDT, maybe on a chain that has like some airdrop potential. That could also be a strategy. Or I could do like yield arbitrage, right? I lend out stablecoins that have higher yield, and then I borrow stablecoins that have like lower borrow rates, and then I could loop that to basically boost my yield. That's also one stablecoin strategy that I could run and basically wait for the market to cool off a bit before I have more crypto exposure. And another thing I could do is I could turn to crypto pools if my pool dumps out of range. Let's say I'm yield farming Ethereum to USDC, but my bottom range is only at $2,000, right? I would have been out of range in the last few weeks here. And instead of not earning any yield or rebalancing down, what I could do is I could rotate into crypto to crypto pools, or I could just lend out my Ethereum using the looping strategy that also worked with the stablecoins. And that's exactly what I did. I was yield farming more Ethereum to USDC when Ethereum's price was trading above 3,000. And then when it was below 2,500, I went into pools like Sol to ETH or Pendle to ETH, made some nice Ethereum profit, and then I could go back to ETH to USDC pool if I want to after the market recovers a little bit. And then we could go another level down as well, right? Let's say I was providing liquidity for Sol to Ethereum. And if Solana underperforms Ethereum, my Ethereum would be fully converted to Solana in that case. Then what I could do also is use Solana to yield farm pairs like Radium and Sol. And this would allow me to basically accumulate more Solana. And if Solana's price recovers against Ethereum, I could always hop back into that pool later and then eventually work my way back up to Ethereum to USDC when the market conditions are good. So that's a very simple liquidity rotation strategy that you guys could implement to basically have different options based on what the market does. And that's exactly what we want, right? The market could either go sideways, go up, or go down. And if you know how to react in each of those situations, then it's very likely that you're going to be able to make a profit over time. The fifth mistake is picking weak assets, especially against the quote asset that you're providing liquidity for. Let's say I'm yield farming AVAX and Ethereum. I want to check AVAX's price against Ethereum and see if it's likely to outperform Ethereum in the next 6 to 12 months. If you guys are on TradingView, you can see that right now the asset is based on USDT. That's the quote asset. AVAX is being priced in USDT right now. And what I could do is I could change it into these other currencies, right? If I'm providing liquidity for AVAX to Bitcoin, for example, then I want to be looking at this chart and basically try to bet if it's going to move up against Bitcoin if I'm trying to accumulate more Bitcoin. But you can see this pool is probably not that great to get into if I'm trying to accumulate more Bitcoin because AVAX has been bleeding out against Bitcoin for quite a while, right? Unless I have pretty good reasons why like this trend might reverse, then I shouldn't be hopping into this pool if I don't want to lose that Bitcoin. Let's compare that against Ethereum. So this is actually moving like more sideways compared to Ethereum, which makes sense because a lot of altcoins have been underperforming Bitcoin for the last few months. So this is actually trading in a zone of support. If I believe that AVAX is going to outperform Ethereum in the next 6 to 12 months, then this could be a good pool to get into if I want more Ethereum profit. Because if I enter back here and then AVAX outperforms Ethereum, I'm going to have a positive impermanent loss because I would always be sitting in Ethereum profit in terms of original liquidity because whatever AVAX I bought at this price is being slowly sold into Ethereum at a price that's above my entry, right? So that's how I think about different entries and how I evaluate my performance. I like to look at relative strength, see how AVAX would perform against the quote asset. That's one way. And then what I like to do as well is compare it against other tokens. For example, I could compare AVAX against Solana because they're both layer 1 tokens. You could see AVAX has been underperforming Solana for quite a while here, but maybe it's considered a value buy because it's really weak compared to Solana. If there are some catalysts that are coming up for AVAX, maybe it could reverse its trend against Solana. And I could compare it against other layer 1s as well, like Sui, for example. I could look at AVAX and Sui. So if I look at this chart, you can see AVAX is not performing well against Sui or Solana either. So it is definitely trading at a cheap price compared to those two tokens. But if I want to bet on strong tokens, then maybe I would provide liquidity for stuff like Sui to Ethereum or Solana to Ethereum instead of AVAX to Ethereum, if I believe that the trend would continue. But basically, that's what I want to check. I like to look at relative strength rather than correlation. A lot of people, when they're yield farming, they like to use correlation, but correlation breaks all the time. For example, Bitcoin and Ethereum, over the 1 year span, the correlation is only 0.13. But when I checked the correlation last year, it was much higher than this, right? It was above 0.5. So the correlation, in my opinion, is just not very reliable at all. And it actually doesn't really show like how much it's correlated by, right? It just shows that it's been moving in the same direction for the most part. So I haven't been using this tool much at all. And the sixth mistake I see a lot of people do is they set their ranges too tight. So in this example, let me use Arrow and Ethereum. So I've been able to close this position out for a profit. If we look at my position here, you can see I deposited in February 4th. And then I've been able to collect some fees, compounded a little bit of my fees, and then eventually end up with roughly zero point 0.5 Ethereum profit. If we go back to the February 4th price here in terms of Ethereum, you can see the price is roughly between 0.0003 and 0.00035, which is at its current price right now. And I've been able to secure a nice profit because I didn't rebalance at all. And basically, I've held through like the drawdown and then closed out my position here near my entry for a profit. And it's in a profit because I've earned like a bunch of fees in the meantime, right? And I also closed the position at a price that's slightly higher than my entry. So that's how I typically like to take profit and exit a position. I want to exit when the price is either near my entry if I didn't have a good entry, or basically above my entry at key zones of resistances. But what a lot of people do instead is they chase a range. Let's say they were yield farming arrow back here, right? Back in June and July of last year. And then they rebalance upwards here to chase a range, earn a much higher APR than I am. But because arrow's price began to bleed out, they just chase a range downwards, right? And then maybe they squeeze the range a little bit too much and then missed out on the pump. So this is how you could actually end up with less capital than what you start with. I call it range chasing. And this is exactly what most people do when they're yield farming. And let me show you guys an example of this. So this is Beefy. This does like automated yield farming. You can see there's roughly like 300 something thousand dollars in this pool right now. And what I want to show you guys is that it actually chases the range like what I just talked about, right? It basically rebalances up when the price is high, and then when the price is low, it rebalances down to try to maximize the APR. But the problem with this strategy is oftentimes it underperforms just holding, and the inherent loss is actually greater than the APR you're going to be able to generate. You can see if we look at the historical APY here, and if we look at this entire period, it's actually averaging a roughly 300% APY, right? So really high APY, and over a 1 year period, it should have performed pretty well, right? But if we actually click at this price tab, so this is the price of the pool. It's auto compounding all of the fees, right? Back in June 27th, it's trading at 0.78. And then let's look at the price now, June 25th of this year. The price is at 0.78 as well. So it's been basically flat this entire time. And let's look at Arrow's price over the span of 1 year here. So we were looking at June 28th, right? If I go back to June 28th, you can see the median price is actually at 0.71156 by this C number here. If I go back to that date, right? June 28th, 0.71156. And the current price is trading at 0.859. So slightly higher than what the prices were in the June of last year. So you would have been better off just buying and holding Arrow and not do any yield farming, right? Because if you were in this beefy pool, you basically had like flat performance and zero cash flow because the cash flow is being compounded into this position. And because they're locking in a ton of impermanent loss here, you would have been better off just not doing any yield farming at all. And that's how you could lose a lot of money when you yield farm if you chase the ranges, right? So that's why I don't chase the ranges at all. And then what I like to do instead is look at the weekly chart. If I'm providing liquidity for Arrow and ETH, for example, I want to set my quote asset to be Ethereum and then set my ranges based on the weekly chart rather than trying to capture like really high APR for a short period of time, lock in a ton of impermanent loss when the prices drop, and then miss out on the pump because I had a tight range, right? So I hope that makes sense. And there will be scenarios where the APR is higher than the impermanent loss that you lock in, but those are like the outliers rather than the norm. I would be willing to bet that more than 50% of the pools that's on Beefy are actually underperforming holding and then getting absolutely destroyed by impermanent loss. So something to consider if you guys run like tight range strategies. And the seventh mistake is kind of related to the last one, is rebalancing too often. If you guys find that you're rebalancing once every 1 to 2 months, then you actually probably have a pretty tight range. And with the reasons that I just showed you guys, you don't want to have a tight range, right? Especially, let's say you guys enter at a high price here. You probably started with Ethereum or stable coins when you like enter into this pair, right? And again, what happens is if the arrow to ETH price drops a lot, you're actually suffering a ton of Ethereum loss because your arrow is underperforming Ethereum, right? You're going to be fully into arrow when the price drops your bottom range. And then if you decide to rebalance down here with either a snuggle rebalance or if you're chasing the range, you're actually locking in some impermanent loss. And if the price rips back up, you kind of missed out on the pump, right? Because you had a tight range. The tighter the range, the less capital gains you're going to have. So then you might be chasing the range upwards again and then repeat the whole process again and again. So I see this all the time, even with people that have been yield farming for years. They sell courses or coaching packages, but they're actually making a ton of losses simply by chasing the range, right? What I like to do instead, again, is to set my ranges wider and try to get a good entry if I can. I didn't really get a good entry back in February 4th. I got in at roughly 0.00034, and I was still able to exit for a profit rather than chasing the range and potentially losing a ton of money to impermanent loss. Tight range strategies, in my opinion, doesn't work very often at all. The fees have to be really, really high in really good market conditions for those strategies to actually do well. And if you guys are just rebalancing really often and just playing with it, it's very likely that you guys are locking in a ton of impermanent loss. Rebalancing should be much more deliberate. If you guys want to learn more about rebalancing, check out this video I made. I went through like the step-by-step process to help you minimize impermanent loss when you guys rebalance. And if you guys want to learn more about yield farming and how to become a profitable yield farmer, then be sure to check out my other videos as well. And here's a quick recap here. The first mistake is capitulating for a loss. Oftentimes when there's a big market dump or there's a lot of negative news, those things are temporary. And if you decide to sell, a lot of times you're locking in the loss rather than waiting for a recovery. The second mistake is not diversifying, putting all of your eggs into one basket, either into altcoins or even into crypto as a whole. Then when the crypto market dumps, your whole portfolio would not do well, right? Compounding all of your fees could be a mistake as well, especially if you guys are yield farming a lot of altcoins. When the market pulls back, you're going to be giving back a lot of those gains. Not having a backup plan, not knowing what to do when the market dumps or when positions move out of range, that could be bad as well because you would panic and then could potentially make bad decisions when that happens. So we want to basically be prepared for like the market condition and know exactly what to do in different scenarios. The next mistake is picking weak assets. I like to check again for relative strength rather than correlation. I want to bet on outperformance and accumulate more crypto like Ethereum, Bitcoin, and stable coins over time. The sixth mistake is setting the ranges too tight. If you guys set the ranges too tight, then you could be suffering a ton of impermanent loss. You're forced to rebalance and manage much more often, and it often underperforms wide ranges unless the fees are really, really high. And then if you guys rebalance too often, you could be locking in a ton of impermanent loss and underperform holding in the market or just lose your money over time. So those are all of the things to consider, and hopefully this video will help you avoid these mistakes. Thank you for watching. I'll catch you guys next time.